Asian markets, they've started the day on a slightly greener note as against the previous few trading sessions where we have seen a bit of declines, and that's primarily because we saw a bit of a bounce back on Wall Street as well. The Dow closed higher by about 35 points. The Nikkei trading higher by about 1/5%. The dollar yen has hit the 113 handle, while we're seeing a few sorts of gains in the Straits as well as the Taiwanese index. The only one which is underperforming is the Korean index, which is sitting with a cut of about 1/5% in the red. Now that has extended to about 1/3%. The Straits as well as the Taiwanese indices should come up for you, both of them trading in the green by the tune of around 2/10 to 0.3%. The SGX Nifty, remember, over the last few trading sessions, we've lost about 175 points on the Nifty from levels of 10,774. There you have it, the SGX Nifty indicating a mildly green tick. Let's see where it goes from there.
Okay, well, let's tell you about Wall Street then. The market recouped previous sessions' losses to end mostly higher. S&P and Nasdaq ended in the green, led by an up move in technology stocks. The Dow Jones closed just below the flatline, erasing a 200-point jump as shares of Apple failed to hold on to strong gains. In economic data, durable goods orders fell 4.4% in October, while the weekly jobless claims rose to a more than 4-month high last week. Remember, U.S. markets will remain closed today on account of Thanksgiving. CNBC's Didier Bossa gets us a wrap of all what took place on Wall Street.
Well, the day started on a much more positive note. Big tech rebounding, all the fangs bouncing back. But as we headed into the afternoon, the major indices sold off and closed more or less flat. You just ran through the numbers. But the Dow erasing a 200-point gain. Apple failing to hold on to its gains. The index, the Dow, is down 950 points so far this week. So tomorrow is a holiday. It's Thanksgiving, of course, and that may be a welcome respite for investors. Take a bit of a rest, and Friday, of course, is a shortened trading day. As Mandy mentioned, retail propped up markets today after a rough one yesterday. Gap surging nearly 5% as it considers closing hundreds of stores at shopping malls. The brand sales, they continue to slide, but sales at Old Navy and Banana Republic are holding up better. In the third quarter, sales at Gap stores, open for at least 12 months, they fell 7%. The stock is down 25% for the year. Shares of Foot Locker, they jumped almost 15% after the shoe retailer reported earnings of 95 cents per share, which was better than the street was expecting. The increase in revenue was thanks to strong shoe sales and women's apparel. And speaking of retail, Black Friday is Black Friday, one of the biggest shopping days of the year here in the U.S. The National Retail Federation predicting 164 million Americans will shop in stores or online over the weekend.
Okay, well, on that note, let's get in some expert opinion on the road ahead for the markets.
Stock investors are anticipating slower growth ahead, and that's not surprising. We had 4% plus growth in the spring, summer, so the slowdown is not, unanticipated. But I think stock investors are anticipating that. But more broadly, I think this is more what's going on in the stock market is a typical market correction. The market's down about, at worst, 10% from its peak. Given higher interest rates, given the trade war, given the slowing of growth, I think that's all should be expected. So I don't think it's signaling a dramatic weakening in the economy, but certainly a slowing. Growth is slowing, but it's slowing from a very torrid and, as we know, unsustainable pace. It was just juiced up by the deficit finance tax cuts that are now fading away. So, this slowdown is completely to script, not unexpected. And the slowdown, you have to put it into context. We're slowing, but the rate of growth is slowing to a pace that's well above the economy's growth potential. So unemployment is going to continue to decline. So we're at a 3.7% unemployment rate. If everything sticks roughly to his script, the unemployment rate is going to be closing on 3% by the end of next year going into 2020. So I think he's got to send the signal that he's staying the course despite all this Sturm and Drang in the markets. I mean, this is just typical.
We think the economy will grow, but at a much slower pace. So it started this year growing at an annualized rate of about 4%. By the end of next year, we think it will be growing at around 1.6, but still positive. There are some significant uncertainties which markets are focused on, in particular the stress we're beginning to see in high-yield credit, concerns about world trade, of course in Europe, political risks related to specific issues. But fundamentally, I think what started as a worry about rising inflation and interest rates late in the summer and in September has really morphed into a concern that we are at the end of the cycle and growth is going to come down a lot, and importantly, profit growth is going to come down a lot. And I think that's what the markets are responding to.